It is the first trading day of 2026, and joining us right now on the fixed income market is Priya Misra, JPMorgan Asset Management Fixed Income Portfolio Manager. Priya, it was an unusual year in that the equities markets and the bond markets both performed pretty well for 2025. When you're looking at 2026, are you thinking all clear at this point?
I think, so there was a lot of narratives that the bond market had to deal with last year, right from tariffs, Fed independence, the Sell America theme, and we were very resilient, to your point. I think as we look into this year, it's going to be more about the labor market. I think even though nothing about the Fed was easy this year, the easy steps of rate cuts were done. So I don't want to start by saying we have to do more work, but I think we have to do more work this year to understand what's the labor market like. I know we're in this low hire, low fire. Is that starting to pick up on the firing side? In that case, the Fed cuts a lot more. Otherwise, if we stay in this low fire, low hire, we're going to look at the inflation side. And if inflation struggles to fall, then the Fed may not cut a lot. In our base case, by the end of the year, they're going to cut 2 more times. So it's less than what they did last year. But it's going to be very data dependent. Last year, we were in very restrictive territory. So the Fed, I think the bar to cut was a little bit lower than it is going to be this year. And then on the credit side, I think we're priced for perfection. So we'll be watching for how much AI-related supply is going to come in. What is free cash flow like? Is profitability, leverage, all of that, just to figure out what sectors to overweight. Spreads are tight, but there's value in credit. So we still think it's a good outlook for the bond market this year. But I think you'll have to do work in terms of how much of duration risk to take, how much of credit risk to take.
You make the interesting point that we have had garbage data for the last couple of months because of the government shutdown. So you're flying blind a little bit.
We are. And, we've had data. I'm glad we've had some data. We're looking at the totality of data. But beyond so typically at the end of the year, there's a lot of seasonal adjustments that can throw off data. So we have that, plus the shutdown, plus a lot of, this year, the last year, there were a lot of trade-related changes. So we've had to adjust how much of this is trade, how much of this was import. So yes, to your point, the data, I think you should take all the data we've had with a pinch of salt. I do think we're looking at the totality and we're seeing the consumer being resilient. We're seeing the K-shaped economy, meaning the upper income consumer, the high, large cap companies doing well across, all the metrics, the lower end doing weaker. But next Friday is a big day. We're going to get, I think, the first clean read of the labor market. Now, I will say you have to make that adjustment. Chair Powell said 60, 70,000 lower. So let's look at what numbers are we getting for December payroll, make that adjustment, look at the unemployment rate. I prefer the unemployment rate because it's a ratio. So if you're missing something in the numerator, you're also missing it in the denominator. Does that continue to tick up? And that's going to create the case for the Fed to cut more. We're hoping not a big increase, but then you'll get concerns around is the labor market struggling more. So next Friday is a key one. But yes, I think you can ignore much of the data so far.
When you talk about the easy cuts or the path was somewhat more clear in terms of getting rates lower for the Fed, it seems like logical that there should be a good amount of friction and disagreement on the committee once you get closer to the neutral rate, and that's where we are. So maybe that's not much to be made of that, given the political influence discussion and all the rest of it. But I also think you have to maybe have a view of, even if we cut twice more, what happens to the longer end of the curve? I mean, do we have this continued resilience to the high side of longer term rates?
Great point, because the Fed really only controls the very front end. I think they are buying bonds, but again, they're buying bills to keep the money markets functioning, the plumbing functioning. The long end is all about the deficit. Do we get any additional fiscal spending? In our view, not really. We've already had the one big, beautiful bill. I mean, the curve has steepened. Investors are getting more compensation to extend out in duration. We don't think you get a lot more steepening here. So if the Fed, cuts rates, I think it can bring front-end rates low. I think the long end stays anchored. In our view, 3.75 to 4.25 on the 10-year is the likely range for the year if we stay in this sort of soft landing mode. If things slow down, that long end can actually fall. Unless you get some big fiscal, and IEPA was a big question mark. I mean, even if IEPA is overturned, we think the president's going to find other ways, or the administration, to impose tariffs. So the deficit, which was something that stressed the market, I think, a lot last year, it's less of like the top issue for this year.